America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome to America's Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with and laugh. I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Thanks for spending some time with us. Remember, if you have any questions or comments related to this show, contact us through email or Twitter. Our email is info@creshow.com, and our Twitter is @BullRealty. Well, today we're going to look at the office market, including a third quarter U.S. market update. We'll also share cap rates and investment sales information. We'll also look at some of the latest office design features. And yes, we will peer into the Commercial Real Estate Show crystal ball over here and have some market predictions for you. Well, please welcome my first guest, Ryan Severino, senior economist with Reis. For more than 30 years, Reis has been a trusted provider of impartial commercial real estate performance information and analysis. On a monthly basis, Reis provides updated trends and forecasts of rent, vacancy, and inventory for all these sectors: apartment, office, retail, and industrial, in up to 200 metropolitan areas and more than 1,800 submarkets. Ryan, welcome back to the Commercial Real Estate Show.
Thank you, Michael. Glad to be back.
Well, thank you, Ryan. And what did you see in the third quarter related to numbers for the U.S. office market?
We saw that vacancy declined by a scant 10 basis points during the third quarter, from 17.2% to 17.1%. While that is not an exciting result, this is a slight improvement from the second quarter when the vacancy rate was unchanged. On a year-over-year basis, the vacancy rate's down by about 30 basis points. And with the labor market struggling, demand for office space unfortunately remains at very low levels. During the third quarter, about 5 million square feet were absorbed. It's a little bit of an increase versus the second quarter when we saw about 4.5 million square feet absorbed, and it's down a little bit from the 5.3 million square feet that were absorbed a year ago during the third quarter of 2011. So not a spectacular result by any stretch of the imagination, but at least we're still trending in the right direction.
Right, and that's tepid growth there, I tell you. So what about rental rates? Any increase there?
We did see asking and effective rents both increase by about 0.2%, about 20 basis points during the third quarter. This is roughly equivalent to the increases that we saw from the second quarter. The good news is this is the 8th consecutive quarter that both asking and effective rents have increased. What is a little bit disconcerting is that rent growth appears to have slowed a little bit over the last couple of quarters. On a year-over-year basis, rent growth is clearly decelerating. So this is a little bit disheartening after the rent growth that we saw earlier in the year, which had begun to accelerate a little bit. I would say during the second half of 2011 and early 2012, we saw some early indications of acceleration. But with such weak rent growth, we're really seeing rents now still mired at levels that we last saw in 2007, which unfortunately means that office rents have basically been treading water over the last 5 years.
Yeah, I guess there's still a little uncertainty out there with businesses looking to expand and hire. Well, what about office investment sales? What do you see related to cap rates and sales volume?
We've actually seen continued moderation in sales activity this year. Sales volume has kind of hit a little bit of it trended downward earlier in the year, and it appears to have hit a little bit of a trough. Quarterly sales trends are coming in, even through the third quarter, about $10 billion per quarter. Even on cap rates, we've seen a bit of a moderation, with cap rate compression slowing this year. It appears that cap rates, at least for now, have stalled a little bit and are bottoming out somewhere in the mid 7% range. And it just seems like there's a little bit of fatigue on the part of investors. They've been investing in high quality trophy caliber assets for the last few years, which is really what's been behind the downward trend in cap rates. But that's only sustainable for so long without strong economic growth and improvement in the labor market. And in the absence of both of those things, there does appear to be at least a little bit of investor fatigue at the moment. They're at least taking a slight break, if not easing off the gas pedal completely.
Well, that's interesting that cap rates are leveling off a little bit. I mean, is part of that because you're seeing more investors now investing in B properties or in some cities that didn't see activity before?
There's certainly some of that. I think part of it is the fact that pricing has gotten so expensive for high-quality properties that it's not as an attractive a proposition as it once was. And then I think you're seeing some investors who would like to invest in office who are being priced out of those really high-quality properties in those primary gateway markets that are now training their sights on markets that they wouldn't have considered, say, a year and a half, 2 years ago, just because they were so risk-averse at that point in time.
Right. Okay. Well, here's the big question, Ryan. What do you predict for 2013? What kind of performance do you expect to see?
I would say through this year and even into next year, there's still a lot of uncertainty about the U.S. economy. Moreover, we still have the debt crisis in Europe that remains unresolved. It's not going anywhere. We're not exactly sure what's going to go on with the fiscal cliff, although my expectation is that our genius leaders in Washington will get their acts together and will avert that. And so my expectation is that many organizations are for the time being are going to be rather unwilling to make decisions about hiring and business plans until they feel like the economy is on a little bit more solid footing. Unfortunately, this is having a bit of a paralyzing effect on the economy and the office market. And removing this kind of uncertainty is just going to take time. It's going to take a very slow, steady recovery in the economy. It's going to take a little bit more confidence in the trajectory of where we're going. I think even with the Fed initiating QE3 recently, the economy is still likely to plod along for the foreseeable future. Recovering from these kind of banking, financial services led recessions, it just simply takes longer than your typical recession. So I would expect slow improvement in vacancies and rents for the rest of this year and on into 2013. And I would say this outlook's not heartening, but it's not entirely unexpected either. It just takes time to come back from recessions of this nature.
Well, what is your opinion on the election results and job growth, Ryan? And do you think the results either way could have some effect on job growth in the office market?
The one thing that I would say is, I don't have a strong opinion on who will win because I do think it's really competitive. The one thing that I think would help job growth in the office market is just removing some of the uncertainty. I think, with an uncertain presidential election, people are a little bit hesitant to make hiring decisions right now. I think in the long run, unfortunately, it probably won't make a tremendous improvement. Number one, I think irrespective of who wins, the sides are just not willing to cooperate at this point in time. I think even if one party had power in Congress and the White House, we've already seen willingness to use excessive filibustering to prevent the system from working. So I don't see a lot of cooperation in the future just because we turn the calendar year. Like I mentioned, these banking financial services-led recessions take on average 8 to 10 years to recover from, which means we still have at least a few years ahead of us to kind of slog through this. And the other thing is, honestly, we have major structural problems in the economy that aren't going to be addressed simply by, waving a magic wand and lowering taxes and regulation, or on the other side of the aisle by increasing taxes on the wealthy and increasing government spending. And I think until we're going to have a serious conversation about addressing these structural issues in a way that makes sense, we're going to kind of have to tough it through this very anemic recovery.
Well, so what type of job growth do you expect to see?
I would expect to see, pretty much like we've been seeing in the recent past, somewhere between 100 to 150,000 jobs per month on average. I'd like to see the numbers come in hopefully a little bit stronger than they are. We've seen about 1.3 million jobs created year to date. This is slightly under what we saw last year through the same point in the year, which is about 1.35 million jobs year to date. I'd like to see closer to that 150,000 range if we could get there, to see the economy maybe generate closer to closer to the 2 million jobs mark, 1.8 to 2 million jobs on an annual basis. And I'd like to think that with a little bit less uncertainty, we could get there next year. But I think to expect the economy to generate something greater than that 200 to 300,000 jobs per month is just not a realistic expectation at this juncture.
Okay. Well, we're getting short on the time with you today, but what are some of the markets that are doing really well and some of the markets that are still struggling quickly?
What we've really seen in terms of metro performance, it really is a larger reflection of the overall economy. In terms of the markets that have been performing the best, what we've really seen is that it's largely been the technology-oriented metro areas and the energy-oriented metro areas that are performing really well. So places like Northern California, San Francisco, San Jose, Seattle, Austin, Raleigh-Durham, and then the energy markets. We've actually seen places like Houston and Dallas having a fairly strong showing. So a lot of it really has to do with the underlying nature of the economy. In terms of the places that aren't doing so well, unfortunately, a lot of them are the markets where there are two general groupings. It's either some of the markets that really went through a big housing boom and bust, places like Las Vegas, so they're still dealing with the fallout from that. And then a lot of the industrial Midwest markets, which are they're still feeling the pain from globalization over the last few decades and seeing the industrial sector of the economy shrink.
All right, well, Ryan, thanks for joining us today.
Thanks for having me, Michael. Always appreciate it.
If you'd like more information from Reis, visit their website, reis.com. We'll be right back.